I'm Cynthia Rowland, and this is episode 109 of EO Radio Show. Today's episode is the third in a series of technical episodes describing the basic principles of the tax on unrelated business income generated by organizations described in Internal Revenue Code Section 501c3, that it includes public charities and private foundations. As most listeners are probably aware, 501c3 organizations are exempt from income tax generally, but this does not mean that all income generated by the organization is free of income tax. For most organizations, unrelated business income is defined as income from a trade or business regularly carried on that is not substantially related to the charitable, educational, or other purpose that is the basis for the charity's exemption. In episode 107, I went over these defined terms, and in episode 108, I explored the modifications to unrelated business taxable income that provide exceptions to income items that would otherwise fall into the category of taxable income. But these modifications are categorically excluded for a variety of reasons, most commonly because they constitute passive income. In this last episode in this series, I'll cover the exception to the exceptions for income that is debt-financed and thus generally taxable. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. So here in today's episode on unrelated business taxable income, I'm going to be talking about the rules that apply to debt-financed income. As a reminder, listeners that want comprehensive details about unrelated business taxable income should start with IRS Publication 598 for detailed information from the Internal Revenue Service regarding this tax. Note that in this episode, like the other two in this series, I'm only talking about public charities and private foundations, that is, organizations described in 501c3, and I'm only talking about the federal income tax rules. I'm not covering state income or property tax implications, although those can be very significant economic impacts of operating an unrelated trade or business. Before we start on the meaning of debt-financed income, let's summarize the general rules that apply to unrelated business taxable income. This is an important area to consider when an exempt organization has income from a regularly carried on trade or business that is not substantially related to the charitable, educational, or other purpose that is the basis for the organization's exempt status. So let's recap with those general rules. Trade or business means any activity carried on for the production of income from selling goods or performing services by the exempt organization. Activities of producing or distributing goods or performing services from which the gross income is derived do not lose their identity as a trade or business merely because they're carried on within the larger framework of the charitable activities. The second important characteristic is that unrelated business income is from a trade or business that is regularly carried on. Business activities of an exempt organization ordinarily are considered to be regularly carried on if they show a frequency and continuity and are pursued in a manner similar to comparable commercial activities of taxable organizations. And the third aspect of the definition that's important to focus on is the substantially related provision. That is, unrelated business income is income that is not substantially related to the charitable, educational, or other purpose that is the basis of the charitable organization's exemption. To determine if a business activity is substantially related requires examining the relationship between the activities that generate the income and the accomplishment of the organization's exempt purpose. A trade or business is related to the exempt purpose in the statutory sense only when the conduct of the business activities has a causal relationship to achieving the exempt purpose other than simply the production of income. The causal relationship has to be substantial, and the activities that generate the income must contribute importantly to the accomplishment of the organization's exempt purposes. As we discussed in the last episode, there are a number of categories of modifications to the definition of unrelated trade or business. For example, these include things like dividends, interest, royalties, rental income, and gains or losses from the disposition of property, and all of these can be excluded when computing unrelated business income. But there is a big exception to these modifications when the asset that generates the income is debt financed. The policy rationale here is that an exempt organization shouldn't be able to borrow money to purchase assets that generate exempt income, because that would provide the wrong incentive for charitable organizations. They're tax exempt because of the charitable and educational activities that further their exempt purpose, but they can't use this exemption to be simply an investment enterprise. So let's drill down a little bit into debt-financed income. In general, the term debt-financed property means property held to produce income, including gain from the disposition of the property, for which there is an acquisition indebtedness at any time during the tax year or during the 12-month period before the date of the property's disposal, if it was disposed of during the tax year. However, the tax on unrelated debt-financed income does not apply to property that's used for an exempt purpose. The sources of unrelated debt-financed income include rental real estate, tangible personal property, and, for example, corporate stock. These are just examples. They aren't the entire universe. So we start this analysis by looking at debt-financed property and whether it was acquired with acquisition indebtedness. Acquisition indebtedness is the unpaid amount of debt incurred by a charity when acquiring or improving property, or incurred before acquiring or improving the property if the debt would not have been incurred except for the acquisition or improvement. Acquisition indebtedness also includes amounts if, after acquiring or improving the property, it's determined that the debt would not have been incurred except for the acquisition or improvement, and incurring the debt was reasonably foreseeable when the property was acquired or improved. The facts and circumstances of each situation determine whether incurring the debt was reasonably foreseeable. The fact that the organization itself may not have foreseen the need to incur the debt before acquiring or improving the property doesn't necessarily mean that incurring the debt wasn't reasonably foreseeable to a reasonable person. So here's an example. Let's think about an exempt scientific organization that mortgages its laboratory in order to generate working capital that can be used in remodeling an office building that the exempt organization rents to an outside third-party entity for non-exempt purposes. While the debt is acquired on laboratory facilities, which may well be an exempt function facility, in this example, because the debt is incurred after the improvement of the office building, it would not have been incurred without the improvement, and the debt was reasonably foreseeable when, to make the improvement, the charity reduced its working capital below the amount necessary to continue operations. Another important factor to keep in mind is that if an organization converts property that isn't debt-financed property to a use that results in its treatment as debt-financed property, the outstanding principal debt on the property is thereafter treated as acquisition debt. Here's another example. Let's suppose a university 4 years prior borrowed funds to acquire an apartment building as housing for married students. That would be exempt function, and the borrowed funds wouldn't cause it to be debt-financed at the outset. But then fast forward a later year when the university then decides to rent the building to the public for non-exempt purposes. In that scenario, the outstanding principal debt becomes acquisition indebtedness as of the time that the building is first rented to the public and is no longer used for an exempt function. Now, there are special rules for property acquired that is subject to mortgage or a lien at the time of acquisition. If property, other than certain gifts or bequests that I'll talk about in a minute, if property is acquired by a charity subject to a mortgage, the outstanding principal debt secured by that mortgage is treated as acquisition indebtedness, even if the organization didn't assume or agree to pay the debt. There is an exception for property acquired by gift or bequest. If property subject to a mortgage is acquired along with a gift or bequest, the outstanding principal debt secured by the mortgage is not treated as acquisition indebtedness during the 10-year period following the date the organization receives the property. However, this special rule applies to a gift of property only if the mortgage was placed on the property more than 5 years before the date that the charity received it, and the donor of the property held the property for more than 5 years before the gift to the organization. This special exception for property acquired by gift doesn't apply if the organization assumes and agrees to pay all or part of the debt, or makes any payment for the equity in the property owned by the donor or decedent. So let's talk about a few other exceptions to debt-financed property. Property related to the exempt purpose of an organization is not treated as debt-financed property, even if it's used to secure a mortgage or a loan. To fit within this rule, substantially all, that is 85% or more, of the use of the property must be substantially related to the organization's exempt purposes. Related use doesn't include a use related solely to the organization's need for income or its use of the profits. The extent to which property is used for a particular purpose is determined on the basis of all the facts. These may include a comparison of the time the property is used for exempt purposes with the total time the property is used, a comparison of the part of the property that is used for exempt purposes with the part that is not used for exempt purposes. So if less than 85% of the use of any property is devoted to an organization's exempt purpose, only that part of the property used for the organization's exempt purpose isn't treated as debt finance property. So let's think a little bit about property used in an unrelated trade or business. To the extent that the gross income from any property is treated as income from the conduct of an unrelated trade or business, the property itself isn't treated as debt finance property. However, any gain on the disposition of the property that's not included in income from the unrelated trade or business and would ordinarily be exempt as a sale of a capital asset, here, if it's debt financed, it will be includable as gross income derived from or on account of the debt finance property. The rules for debt finance property don't apply to rents from personal property, certain passive income from controlled organizations, and some other amounts that are required by other rules to be included in computing unrelated business taxable income. Property also isn't treated as debt finance property when it produces gross income derived from research activities that are otherwise excluded from unrelated trade or business tax. Similarly, debt finance property doesn't include property used in a trade or business that is excluded from the definition of unrelated trade or business because, for example, it has a volunteer workforce, it's conducted for the convenience of its members, or it consists of selling donated merchandise. As an example, suppose the exempt organization acquires a building within which the volunteer workforce works and sells the merchandise that's provided to the organization. The income from that building is not going to be treated as debt financed income. There's also an important exception called the neighborhood land rule. If an organization acquires real property with the intention of using the land for its charitable purposes within 10 years, it may fit within this exception, and the property won't be treated as debt finance property if it's in the neighborhood of other property that the organization uses for exempt purposes. This rule applies only if the intent to demolish any existing structures and use the land for exempt purposes within that 10-year period isn't abandoned in those 10 years. So as we conclude this episode, let's talk just very briefly about computation of the debt-financed income. The formula for deriving unrelated debt-financed income is average acquisition indebtedness as a proportion of average adjusted basis multiplied by the gross income from the debt-financed property. So as an example, let's think about an exempt charity that owns an office building that is debt-financed property. The building in this example produced $10,000 of gross rental income last year. The average adjusted basis of the building was $100,000, and the average acquisition debt with respect to the building was $50,000. Accordingly, the debt-to-basis percentage was 50%. That is, the ratio of $50,000, that's the average debt, over $100,000, that is the average basis. Thus, the unrelated debt-financed income with respect to the building was $5,000. That is 50% of the $10,000 of gross rental income. A final note on that is that on gain or loss from the disposition of property that's debt-financed is that there's a little look-back rule. If an organization sells or otherwise disposes of debt-financed property, it must include in computing the unrelated business taxable income on the gain from that sale a percentage that's the highest acquisition indebtedness with respect to the property during the 12-month period preceding the date of disposition. As with other unrelated business taxable income from a trade or business, deductions are allowed for the debt-financed property determined by applying the debt-to-basis percentage to the sum of allowable deductions. Allowable deductions are those directly connected with the debt-financed property or with the income derived from it. A final note on calculating income from debt-financed property is to be sure to work with an experienced tax return preparer. There are special rules for net operating losses, the allocation of expenses to the debt-financed property, and many other nuanced rules that may make a difference in calculating the income tax from your debt-financed property. So that's all for this episode. Be sure to check out the show notes for links to the resources mentioned today. Also, Farella Braun and Martel has a YouTube channel, and the nonprofit playlists for the EO Radio Show podcast organize all the past episodes to make it easy to find information on topics relevant to you. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martell. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.